Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Covered Calls and Short Puts. And a lot of times we take the perspective as an educator to talk about when someone might consider a specific strategy. But today I wanted to take the opposite perspective and discuss when a trader might decide not to sell a covered call. I want to talk through 5 potential warning signs that might say this is not the moment to sell a call. I think this is going to be an interesting discussion. At the end, we're going to flip it and bring up a stock that seems to be avoiding those 5 things. We're going to be planning and placing a new trade today. Before we can do any of that, though, let me first of all say hello to everyone who's chatting in already out there on YouTube. Great to see the familiar names. Hello to anybody that might be new. But hello there, we have Will and Selva, Nurse Health, we have Sam, we have Paul, Eva, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you are among those who are here for the very first time, I do want to welcome you as well. And if you're watching on the YouTube archive after the live stream has concluded, enjoy the recording. That's a great way to watch these webcasts. But if you'd like to be here in the live stream, this is a Monday webcast series, and we kick things off promptly at 2 Eastern time. Now, I also want to let you know that my very good friend Barb Armstrong is going to be hanging out in the YouTube chat with the live stream attendees. She's going to be keeping an eye on any questions that might come in just during the flow of the presentation. And if I can't get to those questions, Barb's there to pick up my slack for me. We've worked together for years and years and years. Barb knows her stuff, so thanks for having my back there, Barb. Barb and I would also like to issue an invitation to everybody listening, whether live or on the archive, to follow your favorite Schwab presenters on social media. Barb's already put some links in for the live attendees, but you can find and follow your favorite Schwab presenters on X or on LinkedIn. So you can find Barb on X at Barb Armstrong CS. You can find me on X at Cameron May CS. You can also pop over to linkedin.com/in/Cameron May CS. That'll take you to my profile. You can give me a follow there. Barb's put a link in for the live attendees to her LinkedIn profile. But let's get into this discussion when maybe not to sell a covered call. And as we do, of course, we need to pause to consider the risks associated with trading and investing. Please bear in mind this important information. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set an agenda for today's discussion. Kevin says, oh no, I sold covered calls this morning. All right, good timing, Kevin. Let's see, maybe you want to see if they pass the 5 warning signs that I'm going to talk about today. However, these warning signs aren't to eliminate every covered call for every investor. Some people might disagree. They might have a different set of priorities. That's entirely fine. All right, but here's what we're going to do today. We're going to look at our example positions, see if there's anything that we need to do with those. And I think there is one that we need to attend to today. Then we're going to take a quick peek at what's going on with the markets. And then we're going to use some current examples to talk through 5 potential warning signs that it may not be the time to sell a covered call. And after we've gone through those 5, I might throw in a bonus 6th one, depending on time. But then we're going to flip the script. We're going to look for a stock that doesn't seem to have any of those warning signs and add that to our example paper money portfolio as a new covered call. So let's, Mark, you know what? You just added a really good one. You know what, Mark? I'm giving this one to you. Let's call it 7. Mark says, don't trade a covered call if you don't understand them. That's a great point. Yep. But let's go right to our Thinkorswim desktop software platform. This is the paper money version, and we have 3 existing positions in our portfolio right now. We have Broadcom, we have CAH, and we have Alphabet. So with Broadcom, we own 100 shares. Right now we're in a 21st of August covered call, where we have an obligation to potentially sell our shares at $410 per share. Those shares were purchased at $380.37. So here's what that looks like on our chart. Purchased those shares right here on July 20th in class while the webcast was live. You can always go back and watch the archives for these presentations. Check out the logic of these entries. But at that point, we also sold a covered call, that 410 call, right up here. It looked like there was a resistance right around that maybe 400-ish level, possibly up to about 410. Well, we popped up and through that resistance. That call went in the money. That can elevate risk of early assignment. In paper money, we don't see early assignment, but it can happen in real life. But we've sagged back down below that 410. So stock has gone up since we purchased those shares. That's good. The call value has come down since we sold the contract. That's good. That position's actually doing just fine. We're profitable on the stock. We're right now profitable on the call contract. The contract we sold for about 12 bucks. It looks like we might be able to get out for 2.25. I'm not going to do that now, but some traders might make that decision. Close this up. Just be done with that. But let's move on to our Cardinal Health position. These shares were purchased at 155.40 a long time ago. This one just sort of sat there, didn't do anything. Then we started selling covered calls on it. And there's now some history of covered calls on Cardinal Health. So let's bring up CAH. Bought the shares way back here. You can't even see them anymore. We bought them more than 12 months ago for 155.40, but they just sat there and did their thing. And then our first call we sold right here, very short term. The length of little dashes here tells us the length of our contract. This one was only a few days, and we made $1.16 profit on that one. Sold a July call. That one expired for a profit. We sold the August call, the August 7th call, right up before this earnings announcement. That one expired for a profit. We got through the earnings, and we've now sold a new call at that 240 strike. We've collected 690. That's actually lowered the break even. Let me shrink down this y-axis on our chart just a little bit. You can see our break even is way down here, mostly due to the fact that we purchased the shares at a much lower price, but we've also lowered that break even by about $17, $16.50 through the collection of premiums on call options, but also dividends that have been paid over the time frame of the ownership of these shares. So that one seems to be doing well. We're profitable on the stock. We're profitable on the contract. I'm going to let that one continue to work. Although once again, we sold this for $6.90. We might be able to exit it for about $1.55, fraction of what we were paid. Might be able to exit it comparatively inexpensively. Some traders might decide to take that one off the table, but I'm going to leave that one on. Finally, we have our Alphabet position. Here's the history with Alphabet. Let's bring that up. Purchase the shares. If you go back and watch last week's archive, I had the price here at 349.11, but for some reason the date wasn't lining up. What had happened is I made an adjustment in the position, kind of goofed things up, made it look a little bit strange. Appeared to give us a lower purchase price. So here's the correct purchase price. I had it correct on the chart last time. 349.11 is where we bought those shares. That's interesting because we're at $6 below that right now. So our stock is struggling just a little bit. We've had some good days, but we're kind of we've just sagged a little bit below the break-even point for our shares. And yet, we've realized a gain on these July contracts of $3.15. We realized a gain of $13.40 on the June contract. So we've already lowered the break-even by $16, plus we're in a new contract that has lowered that by another $7. So our break-even is now actually down at $3.24. So even though the price hasn't been doing the heavy lifting that we might hope it would, the premiums have done pretty well. Now, here's the thing. We sold this August 21st 385 call back here on was that August 3rd? Yeah. And the stock has really peeled back. When stock goes down like that, it brings the value of calls down, and this one is no exception. Well, let's go look at what we sold this for, $7.35. What's it trading for right now? There's maybe a nickel left in that call. And we still have some time till expiration. So we could sit around for the next week and see if we can realize that, it's not the next week, I should say for the rest of this week, see if we can realize that final 4.5 cents, 5 cents. Or maybe we ought to close that one up and maybe sell another call option. I think that's what we're going to do. Mark says this Google position isn't really working out, is it? The stock position isn't. No, the options contracts are. So I would say net between the two, yes, it's actually been a profitable overall position. But yeah, Mark, for some traders, if they see the stock seems to be breaking down, share ownership certainly comes with risk. Even if we're selling calls against that, if the stock falls fast enough, it can erase the gains that might be realized on the premiums and pile on additional losses. More to lose than to gain in a covered call. But I think what we're going to do here, let's roll this one out. Let's close this one up, see if we can close it up for a nickel or a dime or something like that. And shall we roll it out? There's a small dividend here, maybe keep an eye on. I'm going to go out here to September though, September 18th. And let's see if we go out to that September 18th expiration. Those are the traditional third Friday expirations. Those are the contracts that tend to have the strongest liquidity. And with the stock around 343, let's start at the money. And I'm just going to see how far we can push our luck here. What if we were to sell the 370 contract? The 370 contract looks like it's trading right about 1% of the current value of the shares. Not everybody's looking for 1% from their contracts, but a 335, let's say a 335 credit might give us an additional potential 1%. I think I'm going to do that. Let's do that 370 call on our roll and go out to the 18th of September. And if it helps to envision that, this actually means we're going to be lowering down to here. Let's draw in a horizontal line. So our stock has fallen down here. So we're looking at maybe selling this contract, right? Let's say around 370. I'll make that precise. Right click, edit the properties. Let's put it right at 370. Just so you can see what we're thinking about here. So we have about that much wiggle room to the upside right now. And in exchange, maybe we're closing out this nickel or dime and hopefully we'll turn that into $3, $3.35, somewhere around there for potential income for the next 32 days. So let's do it. Let's go to our monitor tab. Here's how we can enter the closing order for the existing call and a new order to sell a new contract at that 370 strike. So here's how we might do that. Let's right click. RB Tech Trader asks a good question. What would be the signal to exit the Google stock? How about we go back? Let's make a little plan for that, okay? But let's do this. Let's right click here. Let's create a rolling order. And this is going to say sell a calendar. Calendar is just buying an option and selling an option on the same stock at the same time, which is what we're doing here. So let's choose this. We're going to buy back the 385 call, and then we're going to sell, and Thinkorswim has no idea what I have in my mind. So it says, what do you want to do, Cameron? A few more days on the contract? Same strike? Nope. We're going to go out there to the 18th of September, 370 call. And it looks like we might be able to get, let's say, a 333 credit. How about we say we're willing to do it for even a credit of $3.25 per share? So let's click confirm and send. As I do this, it's going to describe this as a diagonal. That would be true if we weren't already in a position here. But this is in order to buy the 385 call and sell the 370 call for the 18th of September. We're trying to do that for a 325 credit. There are commissions to be paid to close out and to get back into a new one. Let's send that order off and see if we can get that filled. I'm going to let that work, and while it's working, let's address RB Tech Trader's question. And JDLMI says, why not wait a little to see if the stock goes up and collect more premium? So what JDLMI is proposing is if the stock goes up and gets closer, if we're going to get ourselves into a contract at that 370 level, if we allow the price to go up there, get closer, we might be able to get a larger premium. Calls go up in value typically as stock prices rise. Well, there's a risk in doing that. Obviously, if the stock continues to fall, well, then we're not in that call option. We might wind up having to sell a lower strike if we still want to retain ownership of the shares. But where might we draw a line in the sand? Well, our shares have dipped all the way down as low as 315 since we purchased those shares. Looks to me like there may be a stronger support area. with the exception of that one event that's spurred by an earnings, looks like there might be a price floor right down here around 332-ish. We could look at this and consider closing. Let's make a note here. Let's just say consider closing. I don't need to capitalize that. If support breaks. There we go. And then I say consider because we'll just talk about it when, if that happens. Let me edit the properties here so I can change the alignment of my text, switch that to right. So there we go. Puts the arrow on the right. Actually, let's move this up here. Activate that drawing. Let's move it right up here. There, it fits nicely. And because I'm a little bit of a stickler for precision there, let's change that to 332. All right, so Mark's having a little sidebar conversation. That's great, but let's call that the plan, and let's move into this discussion as we're planning to place a new position in our portfolio. What might be a signal, or what might be a set of signals that might tell a trader, hey, maybe right now is not the best time to sell a covered call? I want you to listen to these 5 things as I lay them out. See if you agree with them, because not everybody's going to agree with these. But I don't even need to leave this chart to talk about reason number 1, and that is a trader might consider not selling a covered call. Maybe they shouldn't, if they really, really, really don't want to sell the shares. A covered call is a contractual obligation where we are agreeing to sell some shares of stock to someone else entirely at their discretion at any time during the time frame of the contract. And I've definitely had conversations before with self-directed investors who own shares, and they sell covered calls. And they're like, yeah, Cameron, I don't want to sell my shares, but what I do is I just sell way out in time. I sell way out of the money. I take precautions to make sure the contract is never assigned. That's nice, but it's not a guarantee. And if we do not want to sell shares, we probably shouldn't get into contracts that obligate us to sell shares if someone else wants to buy them from us, according to the terms of the contract. So that's an easy one. And there can be all kinds of reasons. Go ahead and list off some reasons you might think somebody may not want to sell their shares. Obviously, if they own shares of a company, maybe they've done a ton of research and they really love its product, they really love its management team, they really love the long-term forecast for that stock, and it would be a sort of a mini tragedy to them if those shares were ever taken from them, maybe through the enforcement of a contractual obligation. Yeah. Maybe they just love the company. I've run into some investors and some traders, this is relatable, who love the company they work for. They own company shares and they don't want to sell those shares. I knew one guy in particular back in the day who worked for a big firm, owned a lot of shares of that firm, and he thought it would be a sort of a sign of disloyalty to his firm if he were to sell those shares. That's fine. If somebody has a strong conviction regarding a stock, if they have a strong attachment to those shares, whatever their motivations might be, if they don't want to sell those shares, covered calls may not be the strategy for them. And of course, somebody says maybe they have determined that getting assigned might trigger some tax implications for that investor that they don't want to deal with this year. Maybe they want to deal with it later. They have some plan. I don't do tax advice, but yeah, that can influence decisions. So that's all up to the trader or the investor. But the point is, reason number 1 to not sell a covered call is if we really, really, really don't want to sell the shares. All right, reason number 2, let's get into some specific examples. Let's go to our chart. I want to bring up AIZ. This is Assurant. This is an S&P 500 company. And just because it's a big company, maybe one of the biggest companies in the world, it's up there in percentile rankings for big companies. But poor liquidity in a stock's options can be reason number 2 that we choose not to enter into a covered call. I almost said buy a covered call, buy the stock, then sell a call. right? But if we already own the shares, we might think, ooh, maybe I'll get some income, or at least get the potential for income for selling a call option. Let's explore this one. Let's say that our investor owns some shares of Assurant. Shares have done well for them. Maybe they're totally fine. Possibly, maybe they bought it earlier, 6 or 8 months ago at much lower prices. And if a contract got assigned and they got to sell it, a forced profit-taking scenario, well, they'd be okay with that. So reason number one doesn't apply. But then they go to sell the contract. Here's what they might encounter. Let's go to the trade tab. This is a large capitalization company. I think it has a capitalization of like $12, $13 billion, something like that. It's a big company. But as we go out to those 18th of September contracts, let's look. We're around $282. If I go to just the at the money strike, that might be the 280 strike. If I sell a call right now, maybe we can get $7.30 per share for that. And if we got immediate buyer's remorse and we wanted to buy back right away, oops, I didn't mean to sell that call. Maybe I forgot that I was in love with this company, or I don't want to be disloyal to my employer, whatever the motivation might be, right? We sell the call. Oops, I don't want to sell that. Let's buy it back. I got 730-ish. Obviously, we don't know if and until we fill an order. If we buy it back, we might have to pay $8.80 per share. That's $1.50 per share on a 100-share contract. That's $150 down the drain, just like that. Stock price hasn't moved. Time hasn't gone by. Volatility hasn't changed. We have nowhere to point the finger for the loss that we just incurred, except to liquidity. When a contract is illiquid, when there's just not a lot of trading on a contract, and this is one of the biggest signs of lack of liquidity, when there is a wide spread between the bid and the ask, particularly at the money strike, because the spreads can widen as we go in the money, they can widen as we go out of the money, we can widen as we get closer to expiration. Number of things that might lead to this. But if we're out there some distance from expiration, where the at the money strike, and there's a big spread between the bid and the ask, there may not be great liquidity. It might be hard to get into this, even at 730. Might be difficult to get back out, even at 880. And the reason is there's something that goes on behind the scenes. This is going on with a person or a firm known as the market maker. When we want to sell a covered call, when we want to sell a call option, that requires, because the contract requires both a seller and a buyer, there's got to be a buyer out there willing to pay us for that contract, willing to enter into a contractual deal with us. Well, there's not always a buyer. And if there's not a buyer, someone else has to step in to provide some liquidity to the marketplace, and that's this person or this entity known as the market maker. Firm is a better way to put it. But market maker's role is to line up buyers with sellers, and sometimes they struggle to do that in illiquid markets. So then they have to take the other side of the trade, which they would actually prefer not to do. There's risk when we step into a contract like this. Yes, even for the market maker. So the market maker will compensate themselves for that risk. And they do that in the form of the distance. Where did the $1.50 go between the bid price and the ask price? It didn't just disappear into the ether. We didn't just write off $150 off of the ledgers of the U.S. economy. Nope. We lost the $1.50. The market maker got the $1.50. That's their compensation. With highly liquid stocks, with highly liquid options, they don't require much compensation because they're able to get into and out of these contracts relatively quickly, just like we are. There are lots of buyers, lots of sellers. They don't have to take a lot of risk. And so the distance between the bid and the ask narrows. If there's a lot of risk, if there's poor liquidity for that market maker, they will widen that spread and compensate themselves for that risk. Mark says it made the market maker rich. They're not looking to get rich off of these illiquid contracts. They're just looking for a commensurate compensation for the risk that they're taking. So there we go. Now, if you look at the other strikes, much less the at the money, if we were trading just this one that's slightly out of the money, we sell let's say we might collect 210, immediate buyer's remorse, we try to buy back, it costs us right now twice as much. Might have to pay twice as much to get back out right now. Nothing has changed, just poor liquidity. So there's reason number two. Maybe the trader, they might look for wide spreads between the bid price and the ask price. If there is a wide spread there for some, of course, the definition of wide can fluctuate from one trader to the next. But a common filter for that is to just look at the ask price. And if there's more than a certain percentage, let's say 5% or 10% distance between that ask and bid, maybe that's a sign of poor liquidity. So in this example, if we're looking at that 410 ask, if the bid is more than 41 cents less than that ask, then that's a pretty wide spread. Maybe that's not liquid, or there's some potential liquidity issues. Not everybody uses exactly those percentages. That's just sort of a rule of thumb to maybe assist with the concept. All right, so that's number two. Let's move on to number three, and that is maybe our investor, maybe number one was maybe they love the stock and they don't want to sell it for any reason. Maybe they potentially have a great long-term outlook. Well, even in the short term, if our trader thinks the stock looks really good, well, selling a covered call puts a cap for a short period of time, a prescribed period of time, on how much that stock can go up, and the shareholder can participate in those gains. Let's look at Micron as our example here. Let's say that we are a shareholder. Let's say we've owned the shares for the last year. They've done really well. Definitely went through a tough stretch right here. However, if you'll notice, let me zoom in here. Actually, let me zoom in, make sure I catch that recent high, and let's go through this. So the stock went through a rough patch, lower highs and lower lows, and now let's say that our trader has noticed over the last few weeks, the stock is running up to higher cyclical peaks, higher cyclical troughs, higher cyclical highs and lows, and just recently, it's even been challenging previous highs and breaking through those. So we got a nice big move up on a 5% up day on Micron. That's a big move on even for Micron. And let's just say that our trader thinks, ooh, this could be the beginning of something good in the short term. Maybe we're going to go back up to those previous highs. All right, if that's their conviction, if they think that we're likely to go up to, let's say, $1,250 from around $1,000, which is where it is right now, maybe the last thing they want to do is put an artificial cap on their ability to participate in that run. For example, if we sold an $1,100 strike right now that expires in September, and then a stock rallies on up to $1,250, well, that's cute. Someone else gets all the gains between $1,100 and $1,250 because we're obligated to sell at $1,100. So if a trader really doesn't want to sell a stock, maybe they don't enter a covered call. If the trader owns a stock, but the options have poor liquidity, maybe they don't want to sell a covered call. If the trader owns a stock, but they think it's about to go for a really nice short-term run, maybe at that moment they don't want to sell a covered call. All right. Now, have I just guaranteed that Micron's going up to $1,250? Nope. I don't know what's going to happen. I just wanted to set an example for what might lead a trader to employ this bit of logic. All right. Number four, some traders do not like to sell covered calls right before what you might call an upcoming price catalyst. What in the world is a catalyst? That's a fancy word. Let's go back to our Broadcom position. Broadcom, we could possibly close this contract out for a fraction of what we sold it for. We're not going to do that today. And then maybe we could sell another call for the September 18th, just like we did for Alphabet. But what might cause you to hesitate? Look at our chart right now. I suspect there are some of you saying, nope, I got 164 people watching the live stream right now. Nope, Cameron, I wouldn't do it. I was okay with it on Google. I don't want to do it here on Broadcom. What's wrong with Broadcom? Well, between now and expiration, there's an earnings announcement. And that earnings announcement, much like Micron, can cause that stock to go skyrocketing. Now, Mark, you've said there's earnings danger. Depends on one's definition of danger, right? When we own shares, there's a danger that the shares could go down on the earnings announcement. That's true. If we were to sell a covered call, the script flips a little bit. Let's say we sold let me just get hypothetical here again for a moment. Let's say we sell the 430 call. That would be about right here at those previous highs. Maybe our trader thinks that the stock's not going to go above 430. Ooh, that's way up there. That's probably not even realistic. I'm going to change my mind here. Let's activate that drawing and drag that down. Maybe it's across these previous highs around 400. Right? And I'm going to put it right there. That'll even drive my point home a little bit more prominently. Let's say that we sell that $400 call. Oops, didn't mean to activate. I want to edit this and make sure it's right at 400. There we go. So if we sell that $400 call and this earnings comes and they just blow it out of the water, just the best earnings. They had a great earnings, a year ago. Let's say they smash that and the stock just gaps up hard. It goes all the way up here at $500 in a few days. Well, that's nice, except we now have an obligation to sell those shares for $400. We've capped the upside. That is a risk, a danger, right, Mark, of selling a call right before an earnings announcement. Now, of course, there's also the opposite risk. We're already shareholders. And if this earnings goes poorly, the shares can collapse in value. That's an associated risk. Selling a call might actually help to potentially mitigate some of that risk, depending on the proportions of the sell-off, if that's what happened. But for some traders, they prefer not to throw that cap on their shares as they go through an earnings announcement. And here's their logic. They might say, you know what? I've got to sit through all this downside risk. Why am I going to limit my upside potential at the same time? So, number 4 is if there's an upcoming price catalyst, something that can cause price to start moving faster in one direction or the other. It's not the only catalyst. What are some other catalysts? Well, maybe there's a pending lawsuit that we think might get settled, could be favorable, could be unfavorable for the shareholders. Maybe the catalyst could be broader, such as maybe this company is highly closely tied to oil prices or interest rates or anything else where there may be some big shift and the trader just doesn't want to cap the upside for the time. All right, what else do we have? We have, moving on to number 5. Let me bring up JP Morgan. JP Morgan's had a really nice run for shareholders. We've been making higher highs and higher lows. Little bit of maybe a shooting star candlestick for those that look at technical analysis. But one thing, so for shareholders, it's been a pretty strong stretch. For covered call traders, this is actually about the mathematically worst time if we're looking to get premium from this stock that we've seen in the last 12 months. Let me bring something up here. I'm going to come up to our little flask icon, explain what I'm talking about. Let's bring up a chart known as the implied volatility chart, IMP volatility. Add that to our chart, click apply, click OK. We have this green line, and this green line is basically a chart of the relative prices of premiums on JP Morgan. So when this green line is high, it means that options on whatever the stock is that we're looking at, the premiums are probably pretty high. When this line is low, it means the premiums are probably pretty low, and it does have to do with how much volatility traders are expecting from JP Morgan in this case over the next 30 days. And if they're just not expecting much to happen, they're probably not willing to spend much on call options or on put options. In this case, we're talking about calls. So when we see the implied volatility low, we're probably going to be seeing quite low premiums, quite small income potential compared to other times over the time frame of the chart. So let's look at those. I'm going to go to the trade tab for JP Morgan. If I look at the 18th of September, stocks at 362. What if we just went up like $7.50? That's only 2% above the current price. If I look at the 370 strike, we can get maybe about 1.5% on those contracts. If I go up to let's see, where's our chart? In any case, what you'll notice is that the premiums on this stock tend to dry up pretty quickly, even on comparatively minor moves on the stock. For some traders, they may have the idea to sell a covered call, but when they go to look at the premiums that are available, they might be just too low in their judgment. They might have to sell contracts that are closer to the current price than they're used to in order to get a relatively larger premium. That's one reason a trader might choose to just bypass selling a covered call at that moment. If premiums are low, if implied volatility is low, especially if it's very low, at those times, maybe the premium just isn't adequate for the trader. They can still make a judgment call here. Someone might say, you know what, that's fine. I'll sell a 370 call. Maybe I can get $5.65 for that. It's going to put an immediate ceiling, I mean, right there, just above the current price for the next 32 days or whatever. But let's go add a stock to our portfolio. And okay, I said I was going to do a bonus one if time permitted. We have very little time, but I'm going to discuss this. If there's a dividend right before the right before the expiration for the contract that we're considering selling, for some traders, they'd prefer not to sell that. Having a dividend right close to expiration can raise the risk of early assignment because we might be entering into a contract where someone has the right to buy shares from us, and they may choose to buy those shares in order to get that dividend. So if that ex-dividend date is falling relatively close to the expiration, it can raise the risk of early assignment. That was one thing I wanted to address as the bonus. Thought I'd throw it in there since I kind of hinted at it earlier. You got 7, thanks to Mark. Anyway, let's add an example position to our paper money portfolio that seems to sidestep a lot of these potential warning signs. And our example stock today is actually going to be XOM. Here's ExxonMobil. This is actually sitting in our portfolio already. Let me expand our portfolio here. Let's go up, just show everything that's in our margin account. And if I look down here, here's XOM. Purchased, what did we purchase this for? Purchased it back here, 147.64. But let's go through our list. Let's just say that our trader, first of all, they're okay selling the shares. It's a contract that says we might have to sell the shares, so we better be okay with that. Let's say the trader is okay. If the shares were assigned, maybe we'll be selling the stock for more than we paid for it, so it'd be a realized gain in that case. Check number 1. Number 2, liquidity. ExxonMobil, one of the very largest companies in the world. If we go to sell contracts, what we're going to see, let's go have a look here at the options chain. And I think for today's example, let's just go with the contract. Looks like there might be a resistance right there at 165-ish. I don't know. Let's check 170. We go to the 170 strike. All right, the 170 strike, looks like we may be able to get about $2.60 for that. That's well above that apparent resistance. And there's only a few pennies between the bid price and the ask price. Does it have liquidity? It appears to. It appears to. A big cue here is anytime we start to see these pennies appear, penny increment options, strong indication of liquidity. Next up, does the trader have a very strong short-term outlook? Well, at this point, maybe not. Maybe they're looking at this previous high and they see the stock sagged back after it touched that high previously. And if it does that again, maybe that'll reduce the likelihood of assignment. If it doesn't, oh well, maybe we have to sell our shares up at 170, which would be right up near those high prices. All right, what else? Is there an upcoming catalyst? Nope, earnings is in the rearview mirror. It's not before expiration. Is there a dividend upcoming? Actually, that's already been paid. As shareholders right now, it's ex-dividend date today. Even if we get assigned, we got that dividend. And what about our implied volatility? It's lower than it has been at times, but it's certainly higher than it has been at times as well. So premiums are likely about average, maybe a little bit on the strong side of average. So let's sell a call. So I think for this example, let's sell right up here near those 12-month highs. Can I say all-time highs? I'm not completely sure. Let me look at a 10-year weekly chart. Yeah, there we go. So if we got assigned, we'd be selling at what previously has been right up at all-time highs. So let's do that. Let's go to our trade tab. I'm going to go to that 170 strike. Let's click on the bid price. We own 100 shares. So we're just going to sell the one contract. And with the natural at 256, the mids at 260, I'm actually even going to say I'm willing to accept 255. That's a little bit below the natural. What I'm doing is just trying to improve the likelihood of a quick fill in these closing, waning minutes of my webcast. Make sure that we can get this done. So let's click confirm and send. We're going to sell that 1XOM 18th of September 170 call, trying to get at least 255. There is a commission to be paid if this order fills. So that would chip away at our premium, bringing our minimum acceptable premium to 254.35 net of commissions. And let's send that order off and see if we can get a quick fill here. And if that fills, I want to move those positions up to our covered calls and short puts. That's up here. Let's go to our working orders and see what's going on there. Yeah, okay, the mark's at 258, limits at 255. We'll see if that fills. Time for me to let you go because we've accomplished what I wanted to do today. And there it is, sold it for 255, perfect. But today I wanted to talk through 5 reasons that might tell a trader, hey, this is maybe not the time to sell a covered call. So hopefully this is an interesting, different take on, and I think it's an important one on this discussion of selling covered calls. And this is what we do on Mondays. So I hope you'll put it in your calendar to join me again next Monday for another discussion of covered calls or short puts. We may sell a short put next week. But I have other webcasts all throughout the week. So do yourselves a favor. If you are new to these webcasts and you haven't subscribed to our YouTube channel yet, do that right now. You can pop down below the video stream, click on the subscribe button. It only takes a second to subscribe on YouTube. It doesn't cost anything to do that. But our YouTube channel, Trader Talks Schwab Coaching Webcasts, is where you can join these live streams. You can also find playlists of previous webcasts. So if I go to playlists here, scroll down a little bit. It's actually kind of toward the bottom. We have a whole bunch of different webcast series. Here's mine, covered calls and short puts. And if we want to see previous webcasts, we'll click on View Full Playlist. And that'll show us, here's last week's discussion. Here's the week just before that, one stock, 3 very different covered calls, comparing in the money, out the money, out of the money. You know, strike selection is a big deal. So you may want to check that out. But another thing that Barb and I would suggest you do is to follow us on social media. You should be following your favorite Schwab presenters on X or on LinkedIn or on both. You can find and follow Barb on X at Barb Armstrong CS. You can find and follow me on X at Cameron May CS. And if you reply to one of my posts on X, I just try to reply right back to you, and it allows for communication when the camera's not on. Or you can pop over to linkedin.com/in, and then /Cameron May CS again is my handle. So it's Cameron May CS on both platforms. Give me a follow on LinkedIn. If you reply with a comment to one of my posts on LinkedIn, I just try to reply right back to you again. Hey, Beauty at its best says you love my teaching style. That's great. Excellent. I'm glad you like it because I'm kind of stuck in my habits now. I've been doing this for 15, 17 years on camera. So yeah, probably not changing anytime soon. So I'm glad it appeals to you. But everybody, thanks for giving me your time today. Barb, thanks for helping out in chat. Thanks for all the thumbs up from everybody. I can see still over 100 people watching the live stream. Got 42 people that have clicked that like button. That helps every single time. It's a pat on the back to your presenter. It also gives my videos a nice boost in the YouTube algorithm, helps more people find them. So if you're watching live or you're watching on the archive and you enjoyed the webcast, make sure you click that like button every single time. It always helps. All right. Thanks, everybody. I don't think we saw a survey today, but if you ever do see one, please do fill those out. But I'll see you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish the very best of luck. Happy trading. Bye-bye.